When you are the one running the show, the question of how to pay yourself is not just a detail. It is a foundational decision for your entire financial life. As a small business owner, you have poured your energy, your time, your dreams into your venture, and you absolutely deserve to be compensated for that effort. The two most common paths to paying yourself are taking withdrawals, often called owner's draws, and paying yourself a formal salary. These are not just different labels. They are distinct financial mechanisms with significant consequences. A withdrawal is a direct pull of money from your business's profits, while a salary establishes you as an employee, complete with a regular paycheck and tax withholdings. Choosing between these two is a strategic decision that goes far beyond getting money into your personal bank account. Your choice influences taxes, your ability to secure personal loans like a mortgage, and the stability of your business's cash flow. It can dictate bookkeeping complexity and legal compliance requirements. An uninformed choice can lead to tax surprises, cash shortages, or missed opportunities for personal financial growth. A withdrawal or an owner's draw is the simplest method to take money out of your company. Think of it as directly accessing your share of accumulated profits, common for sole proprietorships, partnerships, and single-member LLCs. No payroll, no pay stub, no automatic tax withholding, no set schedule. When there's available cash and you need funds, you simply transfer business to personal. It's a direct, flexible way to compensate yourself from the equity you've built. Imagine a sole proprietor running a small graphic design studio. After software subscriptions and marketing, there's $5,000 net profit in the business account. You need $3,000 for personal living expenses. Transfer $3,000 from business checking to personal and record it as an owner's draw. $2,000 stays as your cash cushion. Primary advantage: simplicity and flexibility, no payroll setup, lower admin costs, amounts can adjust with performance. Big month, take more. Slow month, take less or nothing. Downsides: you must set aside income and self-employment taxes on total net profit, not just what you withdrew, and avoid starving the business of cash. Choosing to pay yourself a salary changes your relationship on paper. You become an employee of your own company. You'll set up and run payroll on a regular schedule, weekly, bi-weekly, or monthly for a fixed amount. The business withholds taxes from your paycheck, federal and state income taxes, Social Security, and Medicare. It then remits those withholdings plus the employer side of payroll taxes. Suppose your S-Corporation pays you a reasonable salary, $60,000 per year or $5,000 per month. Each month payroll runs. Gross is $5,000, but take home is less after withholdings. Say about $1,000 withheld for income and figure taxes. The company also pays its employer portion. You receive about $4,000 net into your personal account with a pay stub showing deductions. Biggest benefit: predictability and stability, easier budgeting and planning. Lenders value regular pay. Mortgages and personal loans are smoother with consistent stubs. Taxes are paid throughout the year, reducing the risk of a large surprise at filing. Drawback: more admin and cost. Paperwork, deadlines, payroll software or provider fees, and employer taxes. And the fixed nature of salary can strain a business with fluctuating cash flow. In a slow month, meeting a fixed payroll can be precarious, so choose a level your business can truly sustain. Tax and legal implications are critical. Your legal structure defines the rules: sole proprietorship, LLC, S-Corp, or C-Corp. Sole proprietors and partners pay income and self-employment tax on total net profit, regardless of withdrawals. The draw itself isn't a taxable event. LLCs default similarly. Single member like a sole prop, multi-member like a partnership. Elect S-Corp or C-Corp and everything changes. S-Corp owners who work in the business must take a reasonable salary subject to payroll taxes. Excess profits may be distributions, not subject to FICA. C-Corps pay salaries. Dividends are taxed at corporate and personal levels. Reasonable salary is scrutinized. Benchmark it and consult a qualified accountant to stay compliant and optimize taxes. How you pay yourself directly impacts cash flow. A salary creates a fixed expense, instilling discipline, but also adding rigidity. If revenue is seasonal or volatile, a high fixed salary can strain lean months. You may dip into savings, take on debt, or skip your pay. Withdrawals flex, take more in strong months, less or none when cash is tight. Leave cash for essential expenses like rent and inventory. But flexibility demands discipline. Don't overdraw in good months and expose the business in downturns. Without salary structure, you must be the guardian of cash flow, fund growth, taxes, and an emergency buffer. Withdrawals are powerful for disciplined owners, but risky for the impulsive. For many, this isn't either or. A popular approach combines a modest, consistent salary with periodic distributions. Pay a reasonable base salary that covers essentials, then take additional profit less frequently. Ideal for S-Corp owners, adaptable elsewhere. The salary creates predictable income, satisfies lenders, and meets the IRS reasonable salary rule. It becomes a known expense, easier to plan around. After expenses and salary are paid, surplus profit can be distributed, sharing upside without locking in a high fixed salary. For S-Corp, distributions aren't subject to self-employment tax. First, determine a reasonable salary, ideally with an accountant. Next, set rules and triggers, like minimum cash reserves. So distributions reward true profit, not optimism. Ultimately, the right choice depends on your unique circumstances. Withdrawals, a salary, a hybrid approach. There's no single answer for every owner. Decide based on business structure, cash flow patterns, and personal financial goals. Confirm your legal rules. Consult an accountant. Forecast cash flow and keep business and personal accounts separate. Key takeaway: choose a payment method that supports long-term business, health, and personal stability. Subscribe for more financial clarity with Resilient Boss.